Accounting principles. Now, what are accounting principles? Accounting principles are basically rules and guidelines that companies must follow when preparing their financial statements, and are also part of the generally accepted accounting principles. Now, the principle we're going to be focusing on today is the revenue recognition principle. Revenue is the income generated from the sale of goods or service, whereas recognition is the acknowledgement of something's existence. Therefore, revenue recognition is basically the acknowledgement of income. The revenue recognition principle tells us that revenue should be recorded when it is realized and earned, and not just when the cash is received. This means that businesses should not wait for the payment of cash to be received before recording it into the accounts. Revenue recognition can occur in two ways. Either the service is provided and then the cash is paid, or the cash is paid and then the service is provided. The first scenario is an accrued revenue and the second scenario is a deferred revenue. Now, let's refer to some examples, shall we? In example 1, on the 1st of January, Mike goes to Anna's bakery and orders a cake for next month, and he pays her cash for it. Now, on the 1st of February, Mike comes back to Anna's bakery and collects the cake, which he has already paid for. On the 1st of January, the cash was already received, but it was not until the 1st of February that the cake was already provided. So, when should the revenue be recorded? The revenue should be recorded in February, as Anna did not actually earn the money until she gave Mike the cake. This is known as a deferred revenue, which is recorded when cash is received before the revenue is earned. Here's another example. John asks his friend Mark to do his business assignment for him in May, and John also tells Mark that he will only pay him when he gets his assignment grade back. Now, during May, Mark finishes the assignment and hands it back to John. In June, John receives his grade for his assignment and finally pays Mark for the services provided in the previous month. The service was provided in May, but the cash was only received in June. Now, when should Mark record the revenue? The revenue should be recorded in June, because this is the month in which Mark actually earns his revenue. Now, this is known as an accrued revenue, as the cash is only received after the revenue is earned. As a summary, the revenue recognition principle states that the revenue is recorded when it is earned, while accrued revenue is recorded when cash is paid after providing a good or service, and the deferred revenue is recorded when cash is paid before providing a good or service. Thank you all for watching.
Created using Powtoon.